My guest today, Carlos Vigon, CEO and founder at PaxCap Investors, and I go back a long way before even the last downturn during the global financial crisis that started around 2007-2008. Carlos has always been a visionary commercial real estate investor. He and I negotiated many deals during that downturn, sitting on opposite sides of the table actually, and they were all distressed debt deals collateralized by real estate. And it was only last year that Carlos launched his next distressed real estate fund. Hi, Adam Gower here, and you are listening to the Gower Crowd podcast, real estate syndication in the digital age at gowercrowd.com. So naturally, while Carlos's timing last year was fortuitous to be thinking specifically about distressed real estate before coronavirus hit, what you're going to learn today is what were the drivers for his setting up that fund and what are the exact kind of deals that he looks for. Now, of course, it doesn't matter what you're looking to invest in, distressed deals or not, you still need capital to do that. And if you are confident that you have all the investors you could possibly ever need, then you'll have no interest at all in the whiteboard workshop I've recorded for you that shows you exactly how to find new prospects and convert them into being investors. If, however, you would like to find more investors and raise even more capital, especially right now, when undervalued opportunities are likely to start showing up over the next few months, then go to gowercrowd.com and look for links to the whiteboard workshop training and watch that. Things have changed a lot for sponsors raising money since the last downturn, and I show you exactly what to do in that training to find investors and get them into your deals. It's all there at gowercrowd.com. All right, so now settle into here a fascinating discussion about opportunistic real estate, what to look for, how to find deals, and what you have to keep in mind when investing in distressed commercial real estate projects with subject matter expert Carlos Vigon, CEO and founder at PaxCap Investors. Carlos, so nice to see you again after all these years. So I know you mentioned that we had met pre-last downturn, but I know that our engagement together was definitely more intense the last time there was a big downturn, 2008, 2009. I also know that you set up a fund for distressed real estate only last year. So that was very prescient. You certainly didn't know that a pandemic was coming. But something was in the air. So tell me more about that.
Well, let me talk about that. I had just left CBRE, and I really was longing to do something much like what you and I were doing, 2008, 2011, and so on. And I just really felt that the business cycle, the economy was humming so well at such a high level that much like a finely tuned sports car careening down the highway, that any little pebble in the road, any little jackrabbit crossing the road in a swerve would cause a terrible wreck. So just intuitively, it seemed like there was a lot of opportunity waiting at some point at some time, but I didn't do it thinking that I was trying to time anything. I did it with the basic business model that there's always distress. It just varies. If you look at the pie chart during, like in January, maybe this year, in fact, maybe distress was a little wedge like this. In January of next year, maybe distress is going to be a wedge like this. So it really about a niche, a focus on distress opportunities, regardless of the market cycle. And, at the time, it was contrarian to say the least. I was like last summer when we launched, I was the oddball at the beach wearing a ski jacket, but now now it doesn't seem so odd.
No. So let me ask you a question. How did you capitalize your fund? Tell me a little bit about that. Because now you're out there in the middle of the summer when everything is looking just fantastic. And you're out there saying, come on, I want to raise money for a fund. And everyone's looking to buy distressed real estate. And everyone's looking at thinking, who is this guy with that heavy overcoat on a summer's day? So how did you do that? Tell me more about that.
Well, that's a really good question, because it was something really organic and based on a long time relationship with a friend and a colleague and a mutual real estate deal aficionado. He and I just loved the deal, and he and I had a really good run together during the Great Recession, we'll call that. 2008, again, to 2012 approximately. And, after that, of course, our business models changed. We kind of evolved with the market and where the opportunities were, we could provide service and value and make money. And he and I have been talking for a long time about how sooner or later, there's going to be a big inflection in the market. The cycle was primed for it, and it was just a matter of time. And he was just this unique investor that kind of understood how I was looking at the market, and had a total aptitude and sensibility about the market and the inevitability that there would be tremendous opportunity. And so, we just somehow found each other.
Perfect. So actually what you just described is a single investor. So a single investor capitalizing the fund. But you will remember from the good old days of the Great Recession, when we had so much fun, that there was more deal flow than you had capital for. Not just you, but really those that understood distressed real estate, how to capitalize on distressed real estate. There came a point where there was too much and there wasn't enough capital to buy it. If you could have done, you would have bought a lot more, but there was a restriction, right? There was liquidity. That's why prices went down. There wasn't the liquidity. There wasn't the capital. Even with one investor today, is that enough, do you think, to capitalize on all the opportunities you anticipate are going to be coming towards you now this time?
Well, no, I don't think it's enough. And that's why, since we launched with one investor last summer, of course, I've been on a very informal roadshow with my longtime clients and investors and friends and family, and almost all are either ultra high net worth or high net worth, just in concept, talking about our investment strategy and the premise. And right from the get-go, even when it was totally contrarian, we had a lot of buy-in. And now it's like it's a quick call. Almost without exception, everyone that I talk to wants in, and so it's really not so much a challenge to have the multiple investors, because that's important, because not every investor is going to want to get into every deal, and it's kind of a mix and match. You put together the right cast of investors, if you will, depending on the deal.
That's interesting. So different investors have different taste in the kind of deal that they want to invest in. And let me just ask you this, because, Carlos, that since we last worked together, however long it was ago, 10 years ago, and I know you, before we started the podcast, you were complaining that you
That's right. I think we even shook hands and maybe hugged or something.
Which, of course, we can't do today, even if we wanted to. But you were complaining that you weren't able to buy anything from me during the last downturn, but that's okay. What I was interested in, though, is understanding, as you know, since then, I have started doing crowdfunding, right? So I build these systems to help people find investors, right? These digital.
Yes, congratulations, by the way. I went on your website. It's really well conceived, well thought out, well executed. It's very impressive.
Thank you so much. It's very nice of you to say that. And what I've done basically is taken the task of at least the initial conversations when you're raising money out of the in-person relationships, out of the in-person. Now you can, look at content online and you can establish a relationship. So let me ask you this. With your current efforts, just curious, and then we'll move on to the good stuff, which is the distressed real estate. But with your current efforts, are all of your contacts, are they all in person? Is it the, for want of a better term, the traditional way of raising money, where you'll call somebody, you'll ask for an introduction, you'll go and meet them when that was allowed, or you'll call them on the phone, etc.? Is that the same thing? Is that what you're doing to establish those relationships?
I'm not, because I have been here in the big staycation with my family since March 13th. I'm talking to you from the same place where I've been almost 24 hours a day for the past like 80 days or something like that. So fortunately, most of the investors that I've connected with that are interested in investing, interested in the fund, are people that have long-term relationships with. You know, I've been doing this for 30 years in various incarnations of my career. And so it's mostly that, and those kinds of meetings or a phone call is enough. And I haven't even gotten to the level where under normal conditions, it would call for an in-person meeting. Going forward, who knows what hurdle we need to exceed in order to justify an in-person meeting, because this is also effective and efficient, right? But anyways, it's been mostly by the phone and email and, just kind of keying on some strong relationships.
Okay, so these are primarily existing relationships that you're tapping into. Is that right?
That's right. That's right, Adam.
And so tell me something about, where do you see, first of all, let's do that. Define for me what is distressed real estate, because you have a distressed real estate fund. So what is distressed real estate?
Well, let me tell you that it's not a value add opportunity. And I think if I get another email from a broker with a value add opportunity, I'm going to start getting nauseous, right? And so definitely that's one of the facets. It isn't a value add opportunity. Here's what it is in my mind. It's a real estate asset where there's a situation that has to do with real estate. And the situational has to do with a lot of things that really aren't directly involved with the real estate. So for us, the qualifying definition of distress is that there's distress in the ownership structure, and then there's distress in the capitalization structure, okay? Those are the two prerequisites. And that's where we start with our investment strategy. It's almost like an inside-out approach, because most funds or sponsors that you talk to, they hone in on a geography, they hone in on a product type, and then they hone in on a certain business model of what they're going to do with the property. We don't do that. That's almost secondary. You know, it's a necessary aspect of our decision criteria, but it's not sufficient and it's not primary. So if at this real estate related situation, there is ownership distress and capitalization distress, then we look further. Well, what kind of property is this? Oh, okay, so it's apartments. Yes, that's the kind of property that we know what to do with. We like that asset type. Or maybe it's a marina boat dock business on a lake someplace with some real estate. We might or might not be interested in that, because it's just so far afield from our expertise and from our aptitude, right? It's in a major market, primary or secondary market. Yeah, we're probably in some tertiary markets. But if it's in a small town in Iowa, we probably are not going to be interested in that. But again, those are filters, secondary filters to the qualifying problems with ownership and capitalization.
So tell me something about describe, and let's talk about this current situation that we're in now, right? Again, you and I dealt with the global financial crisis together, right, last time, but this is a bit different, isn't it? So give me an example, like a classic case study, if you like, or an example of an ownership structure that would be something that would be of interest to you in terms of the kinds of deals that you're interested in.
There are various devices that have been created over the past 20, 30 years to facilitate different forms of ownership that have advantages and disadvantages all bundled in, that you take it all with the good and the bad of it. One, for example, is tenants in common structure. There's always been tenants in common ownership, but back in like to the 2000s, it was a big thing. And I'm not even referring to that ticks per se, but I am referring to properties where there's multiple ownership. They're on title as tenants in common, and one owner, let's say, who's in the restaurant business, all of a sudden, his total economic life has been totally changed, and he's no longer in a position to support his ownership interest as a tenant in common in that property, and he wants to sell his fractionalized interest, and so we would approach that owner and those owners to buy just that part of the ownership, and a fractionalized interest in a property sells at a discount to the whole interest. And then once we had the fractionalized interest, then we would perhaps solve to have complete ownership of the property. They're subsequently creating an accretive effect on the value of owning a complete property as opposed to a discounted fractionalized interest, for example. There are properties owned in trust where there's significant disputes amongst the beneficiaries. There are properties owned by corporations where the corporation's insolvent and no longer wants to maintain real estate on their balance books. There are family situations, husband and wife, divorce, owner dies, heirs can't settle on what to do with the property and how to dispose of it. We step in and kind of rescue that situation. And so those are some scenarios. There are so many. Insolvency, bankruptcy, ownership where it's a Chapter 11 and they just want time to have a good disposition scenario for the debtor in possession.
So to be clear,
those are some of the. And what's that?
Sorry, I didn't mean to interrupt you, but I always get into trouble with my wife when I do that, by the way, when I interrupt somebody. So
that's okay with me.
So you're basically looking for distressed deals in the way that you've characterized them. But what you're looking for is a discounted entry point to a piece of real estate, but a pathway to the real estate, right? So, for example, when you and I first started working together closely was when you were looking at notes, right? So that was a bank that had a non-performing asset, a note, and you were looking to buy that. So maybe describe something about what it's like to buy a note and what's involved in that. I presume that's something you'd also be interested in now as well. That's
one of the primary avenues that we find that work for us in our investment strategy is that the kind of the underlying principle here is to take an asset that for various reasons is unmarketable and not liquid in the sense of to what extent there's a market for it, and then go in and cure those defects that make the property less marketable than it would be otherwise. And once we remove those defects to full marketability, then we could go and present the market, expose it in the retail market as a value add opportunity, for example. Or we, again, I and Andrew, we have a long record of being really good value add owner operators. And so in some of these deals, we might just take on the value add facet of it too. But in most, we would not. We just leave that to the very good sponsors that focus on that and get on with the focus of our business.
Oh, Carlos, this is just so exciting to me to be talking about this again. 10 years since we had
it's so nostalgic.
Oh, it is, but it's back again. Right. So what
the whole thing.
Right. So what you're describing for those that don't actually know, who are listening, one guy in my audience that doesn't know, is that you're talking about removing non-real estate barriers to liquidity for an asset. So an asset somehow has got itself locked into a financial or what was the term used? Ownership structure of some sort that makes it illiquid. There's nothing can be done with it. And so you come in and you work out those problems. And once those problems have gone away, that then makes the asset liquid again, right? That's basically what you.
That's right. So buying a non-performing note is just one way to do that. You know, we buy the note at a discount to face. We have some basic assumptions about the property and what it's worth given the likely NOI. And then we have to have a path to control of the property. We're not in the business of just buying non-performing notes and getting a yield. That would be a worst case scenario for us. That doesn't fit into our investment strategy. So we don't want to get caught up in being note holders.
Yeah, you know, but that is a very valid strategy as well, though. I mean, if you can buy a note at 50% and bring it back to performing, and it was, you know, yielding 5% before, now you've got a 10%, right? I mean, you put some finance on it, you can actually do pretty well.
Yeah, you can.
I ended up doing a lot of that, by the way, with Colony. Incidentally, there was after I left the bank, I ended up at Colony Capital, and we had some huge portfolios of stuff over there that were. The funny thing was then, Carlos, was that we would call borrowers because this was a note that had gone into a bad pool for the FDIC and been passed from here to there and somewhere else. And boxes were literally carried from one out of a bank and into a store and then scanned, and stuff got shuffled. And it was for months and months or years. It took a while for this stuff to go. And I remember some of the workout guys saying, yeah, they would call a borrower and say to them, hey, you're 2 years behind on your payments. So what's going on? They'd say, yes, the last time we sent a check, it came back, returned to sender. We didn't know who to call. Where do we send you the check? We want to bring it current. So there were some situations like that where it was like picking up money in the street. But let's talk about, where do you think this time? Now we're still fairly early into this, aren't we, Carlos? I mean, you had the prescience to set up a fund last summer when everyone thought you were a bit potty. But now they all know that you have brilliant insight. Where do you think we are right now in terms of opportunity? And how do you think it's going to roll out over the next weeks, months, and years? Question mark. Will it be years or will it?
It's the question, right? It really is. And so, Adam, let me zoom out and give you kind of my big picture, because I spent a lot of time thinking about this. Maybe too much. I don't know. Time will tell. So, in the big picture, okay, we are at the inception of the greatest social and economic paradigm shift since World War II. And so we're in the midst of the crisis. So it's much like we're hit by the tsunami, this pandemic, this social, political confluence. Not a coincidence, by the way. That's a whole other webinar. But right now it's happening. It's like we're hunkered down and we're hoping that the waves won't overcome our shelter, right? And so it's too soon to know what the extent of the damage is going to be, and it's too soon to know like what the recovery is going to look like and when we could begin the recovery. So we're still in it. I think we're still in it. The tsunami has not passed. All right. So that's how I see it. So because of what's happening with coronavirus, and I want to say that my viewpoint of the corona, and this is relevant, again, I don't want to get on a coronavirus riff, that's yet another webinar, right? It is that until we have three things available societally, that it's still a factor in our lives and our economy. One, we need readily available, reliable testing and tracing. Number two, okay, we need readily available, reliable remedies and treatments. Number three, we need a vaccine. Okay, nothing has changed in that regard since we were all in shock about this initially in February. I mean, some people later, some people still are not really taking this seriously. But anyways, until we have those three things, it's a factor that's going to affect our life going forward. Okay, much like, not exactly, I liken it to the extent that terrorism has had an effect on our society post 9/11. That is, we had the attacks. It was a huge shock. And from that time, life has never been the same. For anybody that travels, at least, life has never been the same. And we've adjusted. Okay. So we now are in a similar but much greater kind of change that really won't resolve until we have a vaccine. Okay, so that means now that this is really important to me in my pursuit of deals, and it goes to our underwriting, especially in our assumptions, because what is a good deal? What is the frame of reference?
Right.
All right. And so this distress is really different from when you and I were pounding out deals 2008, 2012. And here's the big difference, Adam, is that when I looked at a deal in 2008, 2012, let's say a hotel, I knew that hotel that was like 60% vacant, that had an NOI 25% of where it was in 2007, I knew that all I had to do was restore the operation to what it was doing, how it was doing it, where it was doing it in 2007. I can't do that now. Now I have to completely re-engineer, reimagine. If I want to occupy that hotel in the short interim period until we have a vaccine, okay, if I want to have a pro forma that shows this thing having a full occupancy in the near future, I have to reimagine and reconfigure that hotel. I have to get rid of anything that anybody has to touch. I have to eliminate any shared spaces. I have to give each room individual ventilation systems, for example. And this whole protocol, it all has to be restructured, okay? And then I have to know, well, okay, so how much is someone going to pay? What's the room rate going to be? And by the way, I'm not a hotel guy. I just fell into that example because I think hotels are probably the most impacted type of property from all this. So then what's the room rate going to be? How much is this operation going to cost me? And what is that NOI? Okay. And now that's the NOI, giving the risk environment going forward in real estate perceived by investors. What cap am I going to have to put on that? And there's the value, all right? And then from that value, that's where I could work backwards and then start doing some discounting in the underwriting to see at what price do I have to buy it today to have an exit scenario, either a recapitalization or sale, when it's totally reconfigured and redesigned as a post-coronavirus hotel.
Yes, isn't that interesting?
And that goes for retail, that goes for office, somewhat for multifamily as well. Not as much, but somewhat for multifamily as well. So it's a whole other layer of complexity,
right,
in the underwriting process that we didn't have before. And for me, that's a big difference.
It is, because now actually, so I've always said that this is what, actually, just as we talk about it, it's actually quite interesting to think this through. Especially during the last downturn, I came to think that there was no such thing as distressed real estate. There was only distressed capital structure. It was the finance on a project that was distressed. But actually, when you think about it, based, what you're talking about is that actually it is the real estate itself, because of this pandemic, that itself has become distressed in the sense that a hotel might be obsolete, or certain parts
Yes,
of it may now be obsolete, or an office,
incrementally so, right? Yeah,
right?
if
And
not.
if that's happened, even if it's just parts of it here and there, that the economics have also shifted dramatically. And it's because we don't know what that obsolescence actually looks like yet, that it makes it very difficult to calculate value, right? That's what you're talking about. We're in it. We still can't
Yes.
see where we're headed.
Yeah. I mean, if you had a restaurant with 200 chairs, and that operator owner was able to pay a certain rent based on having his 200 chairs filled on a Friday and Saturday night. Well, now he only has 100, and that's how it's going to be going forward for the foreseeable future. Then, how much can the landlord charge? How much is that rent? Is that worth for rent? And then, what does that translate to is in NOI, and then that new value for the property?
Well, what does it even mean that some businesses aren't viable even with zero rent? Right? I mean, I don't know. Restaurants, aren't they very? I'm not a restaurateur, right,
No,
at
neither
all.
am I.
But I think they run on very thin margins. So if you can only take half the number of people, half the number of turnover in an evening, is there any possible way that it can be viable? I mean, so at the end of the day, you buy something that's in bankruptcy, and you figure out all your legal costs and the time it's going to take you to get it through the process, and that kind of risk. Right, your traditional workout scenario at the end of the day is, does the real estate have any intrinsic value left, right? In some cases. So how are you dealing with that? And how are you articulating that to your capital?
The one way, the net of it is that how I'm articulating it to our capital is that right now, when we've been looking, we've been aggressively looking since last year. And I have not yet seen the right opportunity where I'm comfortable that we're going to have an exit scenario that's going to give us some multiples return on equity, which is kind of our investment metric. We're not going for IRR. We're not going for cash on cash return. We're looking to multiply the equity. These are high risk, high reward, high adventure kinds of projects, right? And so I think that because it's so early, because we're still in the tsunami, and we don't know the extent of the damage and what it's going to take to recover and what all that looks like, we think there's lots of time to bide and wait and see and let some of these answers become clear about what is this property going to be worth. Because you find now cash deal flow is starting to come out, and you see that non-performing notes and mostly is what I've been seeing, and it's hard to know, well, at what price do I have to buy it at? What exit scenario, what value is it that you put on it? And it's in some cases it's almost impossible to determine right now. Alternatively, if you're really bold and brave and want to maybe have some big wins and possibly some big debacles, is think of what a goalie does during the end of a soccer match. Okay, penalty kick. You can't know where the ball's going, and if you wait to see where it's going, it's too late, and so you just got to pick a side. So you could make some really bold projections and extrapolate and guesstimate and say that, okay, well, hotels are really going to resume their prior operation, but it's going to take 5 years. And so, but let's go on that assumption and underwrite it that way. instead of thinking that we have to get it operating in 1 or 2 years and we have to redesign the whole hotel. And so you either have to make some big assumptions that are high risk without a lot of reliability, or you have to wait and get more information.
Let me ask you a couple of questions. Yeah, go ahead.
Yes. Does that make sense?
Absolutely. Yes, it does, actually. And you actually trigger some thoughts actually for me. So let me ask you this, because if that's the case, if you're going to buy something and let's say you do assume let's say a 5-year turnaround or return to prior NOIs, for argument's sake, you figure that within 5 years we're going to have, hopefully we're still here, but within 5 years, you know, the NOI, there'll be a vaccine, there'll be some therapeutics, we'll have herd immunity, this thing will be a bad memory and everybody will be dying to get out to do vacation. Yeah. How do you?
I mean, with these protests, if they keep up, we'll have herd immunity in a few weeks.
That's right. Yeah, this is it's very, very bad situation at the moment. Obviously, very troubled. Yeah. Let's hope that.
I mean, I'm in Manhattan Beach, and I've got helicopters circling around, and I hear sirens in the distance. So if all of a sudden I get up and go off camera, it's because I went into the bunker.
Okay.
I had to go into the family bunker.
Okay, okay. All right, as long as you don't go and join everybody, it's good to protest, but you got to stay safe, obviously. But keeping off all of that stuff.
Yes.
So what kind of so one way to shield yourself from the ultimate downside, which is loss, is to buy cash and not lever. And I don't know if you remember when I was at the bank, I was actually offering 80% facilitating loans, so short-term, related to prime, etc. But once those terms ran out, you had to come off and pay off these loans. So what's your philosophy to leverage and when you're buying these deals? Are you buying them all cash or are you borrowing as well?
Because the best situations require pretty swift execution. It's generally all cash. And then we'll take debt if it helps the deal, meaning like maybe it helps to assume some current debt. Maybe there's a lender involved who would be more cooperative if we were going to help them keep a loan on it as an asset and so on. So we're flexible about that, but ready to come with all cash if we need to get the deal. And then after that, we could see, there's lots of options for recapitalizing, leveraging, and so on.
And what about the asset classes that which asset classes do you think are going to be the most, let's say the first ones they're going to flush through? And are some of the most popular, like, of course, apartments? Do you anticipate distress in that asset class?
I do. Again, this is us talking in the midst of the crisis, and it hasn't played out yet. And so it'll be fun to rewind this in about a year and see how prescient we are or we're not. But regardless, it's going to be fun to look back. And so what's going on right now with multifamily is that they are on a basic life support system courtesy of the federal government. And so it's a matter of what the third stage of funding is going to look like. Is there going to be an extension of payments and benefits to unemployed workers? Is their unemployed income going to be maintained at a level above what they actually made when they were working? And there's moral hazards there throughout, but they were trying to get a solution out quickly. I don't fault them for that. Or are they going to turn off the spigot? And then if that happens, midsummer or so, when those funds kind of dissipate, then we could really see fundamentally what's going on in the multifamily business and how many of these tenants are really able to pay. So I think there will be more distress in multifamily right now than it appears, just simply because what has happened over the past 2 months has been substantially subsidized by the federal government, and that's not going to go on.
So Carlos, how is that going to play out? Let's get real. Are you going to find deals off market from sellers who don't want to lose to the bank, right? That just want to pay off their loans? Are you going to be buying them from banks? Are they going to go into bankruptcies? What are you anticipating seeing deal flow coming from primarily, and especially in an asset class that is currently as robust as apartments?
I think it's multifaceted, and it runs the gamut from more conventional workouts with lenders where they just don't want special assets in the books. And you know this very well yourself, firsthand, being in those trenches for a long time. And so we might see the comeback of short sales, for example. We might see lenders agreeing to stay on the loan even though it's not assumable, and adjust the terms, do anything they can to keep it from becoming a non-performing asset. So I think that there's going to be a lot of lender cooperation, and that will be one stage. And then a lot of deals aren't going to be worked out like that. The only way that they could be properly repriced and recapitalized is that the current debt structure has to be pared down and recapitalized, and that will be processed through many different channels. Foreclosure process, of course, UCC foreclosures, bankruptcies,
and so for somebody who wants to, for someone who wants to find these kinds of deals, what are the best avenues for sourcing them? If you don't know guys like me in banks, like the last time, or even if you do, I suppose.
Well, that's one of the fun parts of this business, because it's kind of the secret sauce of it. There isn't a place where you go and there are the deals, and there isn't like a shelf someplace in some virtual supermarket for deals. Not even today, even though you see these things posted in LoopNet and those internet portals. Generally, it's relationships, contacts, and non-retail channels that are not widely available to the public, and that are not subject to the typical retail terms of a typical transaction, i.e. cash, i.e. lack of full documentation, lack of full representations, lack of full disclosures, as is, in exchange for some pretty substantial discounts. And then let the buyer beware. Do as much due diligence before you close that escrow.
That's right. You remind me. That's right. No reps and warrants. That's right.
Remember that? So
that was so much fun. Yeah.
So that's how the deals will get done.
Interesting.
And so for us, PaxCap Investors, I think again our distinction is that we really focus on the capitalization and the ownership. Number one, we are not pressed to transact. We are not pressed to put money out of a fund. We're in a very good position where we are ready to bide our time and time it right. You may recall this, but there were a lot of early real estate geniuses that jumped in, like in 2008. No, this is it. This is the opportunity. Let's buy now. And they, unwittingly, later on in 2009, 2010, became distressed sellers because nobody imagined how far and how deep the distress and the dislocation was going to be. I think that's one thing in common with this crisis that we're in today, is that right now it's hard to really quantify and know how broad and how deep the distress is going to be. And to buy now, you might just be another distressed seller in a few years. So we're really conscious of that and not in a big rush. Additionally, there's all the headlines about all the big funds, the private equity firms with the incredible amounts of capital. Right.
Yeah.
And there was only so many deals to go around.
Yes.
And not all that capital is going to be deployed. And so our focus is kind of mid-market, 5 to 50 million, and kind of sub-institutional. And so, in that space, we have a good niche, and we'll definitely get our share of opportunities and do a really great job for our investors.
So, Carlos, I'm going to ask you one final question before I ask you 3 final questions.
Is it time to go already?
I can't believe it, actually. I just looked at the clock. It's unbelievable how fast it went, actually.
We must be having fun.
Crazy fast. And there's a lot more. I'd love to reminisce with you as well. We can chat a little bit offline before
I hope so.
But let me ask you this. So actually, I want you to make a prediction. I know you're not going to like this, but I want you to make a prediction. Well, maybe we'll come back in a few months and we'll have a look.
You mean like the one I made last summer?
Yes, but this time I want you to put a date on it. When do you think you'll close your first distressed deal? When do you think that's going to be?
I think it's going to be probably first or second quarter next year.
All right. Well,
odds are we'll do something sooner, but if we do, it's because I'm being a little impulsive. But that's probably not going to happen.
Fine. So let's leave it then, and we'll definitely revisit. 3 last questions. I got 3 sign-off questions that I ask all of my guests. These are just they call, I don't know, rapid fire kind of thing.
Okay.
3 questions. Carlos, what are your key daily habits that make you successful, or that you anticipate will make you successful in this venture on distressed real estate? Key daily habits.
I get up early, I meditate, I realize and visualize that there's so much expansive abundance and energy and health and potential in the universe, and that I'm connected to it. I think we just lost like 3/4 of our audience.
No, that is fantastic.
And so after the meditation, I go out and work out, plan my day. These days, I get my 6-year-old boy started with his kindergarten, and I sit next to him and make my calls and send my emails, and it just always start the day, a reset, a plan, and knowing it's the end of the day. And every day there's so much work to be done after really it's time to stop and to reset and recharge and start new the next morning with the next meditation. So that's kind of
get up and
my process. And it's been really interesting and different doing that here from home consecutive for the next 80 days, for the last 80 days or so. It's a super challenging but super special time to be so close with our children, and I think we're never going to forget that.
Yeah, I wholeheartedly agree with that.
And I am so pumped up about all the amazing changes in spite of the tragedies and the loss. Out of that, always in America, we've seen tremendous gains and recovery and redemption, and I think this time it will be no different. And that's why I came to this country from Cuba, and I'm just glad to be here, part of the process, and grateful to be in this business. And thank you for the chat, Adam. We got to hang out some more.
Well, I've got 2 more questions. Hang on a minute. Next question.
Oh, you mean that wasn't all 3 of them? I think I answered 5 questions there.
2 more questions. Quick ones. Hardest lesson learned in real estate. What's been your hardest lesson?
The hardest lesson learned in real estate was in 2007 when I was looking just in one direction. I was all in, all long, and fully invested in a plan that the market was going to continue its run. And then a strange thing happened in January 2008 when I was about to get a loan commitment on a deal in Oklahoma City. And then Credit Suisse called me up and said, hey, yeah, we can't do that $40 million loan. We're going to give you your deposit back. And then it really made me like aware that it's something that I knew, but we get caught up looking at things in one direction and only reinforcing ourselves in what it is we believe is happening. And so I got caught up in a feedback mechanism of my own desire to continue with this run that I was on, and didn't look at the signs, didn't look at the evidence. And so I'm much smarter, wiser now from that. So I learned to keep overhead low, be efficient, be effective, and not to ignore the fact that real estate is a cyclical business. As long as there is debt in real estate, it will always have erratic cycles. So I have to remind myself that.
Carlos, fantastic. Last question. Advice to somebody who is looking to buy opportunistic, distressed commercial real estate today. What advice would you give them? Or to invest in, I should say. To somebody looking to invest in distressed real estate today.
I would say that you really need to know what a true distressed value is. And right now that's one of the biggest challenges because of everything that we talked about in terms of we don't know what the non-distressed values are going to be. And you have to work off of that backwards to know what price you could pay as a distressed asset, because you have risk, you need returns, you have expenses involved and time, and your capital to get the property up to a level, to its retail level. So what is a correctly priced distressed asset? What is that price?
Carlos Vigon, thank you so very much. What an enormous pleasure to see you again.
Thank you.
Thanks so much for taking time out to join me.
Likewise. What a treat. Glad to do it anytime.
That was Carlos Vigon, CEO and founder at PaxCap Investors. I've included links to Carlos's firm and his online professional profiles on the podcast page for today's episode at galcrowd.com, where you'll also find access to the Investor Acquisition System Master Course that you can enroll in so you can raise money online for your deals no matter what you are investing in. That's all there at galcrowd.com. Hey, thanks so much for listening today. And thank you, Carlos Vigon, for your time with me today. It was super good to see you. I really enjoyed talking to you. I look forward to the possibility of working with you. Some very exciting times up ahead. Thanks again for being on the show. That is all for this episode. I will see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.